Have we been misled on historical stock returns? This actually bothers me quite a bit. So we're going to look. I got Jeremy Siegel's Stocks the Long Run. This is a version 3rd. And I got Jeremy Siegel's Stocks Long Run version 5th. All right. This is after the great financial crisis. This is 92. I'm not 92, 98 or something like that. Let's see. This one is 2002. All right. Anyway, so the premise of and I like Jeremy Siegel. I'm a big fan. Check this out. So here is the chart that he will use. This is on version 2000. So this probably won't be mine because he's looking at 2014. He's talking page 82. Let's just see. Now, I've learned a lot from this book when it comes to stock returns, especially small cap. Yeah, there it is. Yeah, page 82. Same. So let me show you here. We're going to go into this a little bit. And that's that right there. All right. So we're going to show you what that's. I mean, look, you'll say, oh my goodness, since 1802, stocks, if you started with $1, are worth $1 million. Bonds, if you start with $1, are worth $1,000, whatever that is. 10,000, not 10,000, $2,000. Cash is worth 150. Gold is worth 8. And the U.S. dollar is deflated. All right, negative 1.4% a year. That's the inflation. So I've always thought this. Now, I've known some people say small cap value stocks outperform, and because of Jeremy Siegel's book, I know it's true, but it was only true because there was a certain amount of time, like 78 through 83 or something like that. I can't remember. Take away those 5 years, and there's no premium value over small cap value. But you have to read the book to know that, and a lot of people don't. But check this out. So this is my man, Ed McQuarrie, who I've been reading a long time. And this is Dateline. When did he write this article? Hold on a second. I'm not going to do that. I can't remember. It's just 2019, I think. No, 2021, right here. I just I'm stunned here, and I'm going to show you something here. So first of all, we're going to show you likewise. No part of Siegel's bond record includes corporate bonds, even during the decades when these dominated the fixed income markets. All right, so this is only government bonds right here to get this. And actually, hold on a second, right here. His theoretical commitments required him to use the best available proxy for a risk-free investment. Okay, in the absence of a deep and liquid treasury market, Siegel approximated the risk-free bond by always selecting the lowest yielding federal or municipal bond available. What? Even when yield was depressed by tax exemptions or other privileges. So that's so we're going to use municipal bonds and interchangeably with government bonds. We're never going to use corporate bonds. Okay, that seems kind of weird. But remember, municipal bonds are tax free. So because they're tax free, inherently they have less yields. They don't need to provide you as much yield because they're tax free. So anyway, so I was like, okay, that was, I didn't think about that. All right, so right here. Figure 2 shows terrible long-term performance by bonds from 1943 to 2013. Stocks rose far ahead of bonds during the decades immediately following World War II and never fell back. But Figure 2 is highly misleading. Not one investor in 1,000 can look at this chart and detect that following the 1982, the stock and bond performed parallel. So you're going to see this, like, look, from 1943 to 2000, whatever that is, 18, something like that. The stocks smoked the bonds. But that's not true from 1983 on. And if you look here it is from 1983 on. They basically rode in tandem, stocks and bonds. So you had this 40-year time frame from basically I think it's 43 or something like that, I can't remember off the top of my head, to basically 1970. Where stocks just smoked and bonds got smoked. Again, but these are not corporate bonds. These are some of them municipal bonds. It's just weird. I didn't like. I've read this article about 2 years ago too. I think it first came out in 2019. He updated in 2021. And I missed what I'm about to tell you here. I saw some stuff. I missed what I'm about to tell you though. But that's not even the gist. So if we go back to this right here. So right here, you can see the bond market from basically 35 or so to 1970. It basically is a 40-year time frame. The bonds actually lost money, net of inflation, where stocks ramped up. And so this right here, that 40-year time frame is what makes the stocks versus bonds look great. All right. Now, but you even say, but Josh, but even before that, other than like from 1802 to 1862, when bonds and stocks rammed together, but even from 1860, basically five, since the end of the Civil War, till right here, 1945, stocks did better, significantly better. But check this out. This is crazy. Siegel sources omitted this right here is insane. Right. Siegel sources omitted the largest single stock that traded before the Panic of 1837, the Second Bank of the United States. At the peak, before the panic hit, the Second Bank of the U.S. accounted for almost 30% of total market capitalization. It failed spectacularly as the panic proceeded, with shares dropping from 120 to 150, sounds like First Republic Bank, and never recovered. To duplicate this omission in a contemporary stock market, it would be necessary to drop Microsoft, Apple, Amazon, Alphabet / Google, and Facebook from the S&P 500. And even those five would not account for as high as percentage of the S&P 500 as the Second Bank of the U.S. Omission of the Second Bank of the U.S. is the single most glaring error I found in Siegel sources. More generally, I found incorrect survivorship bias elsewhere. Banks failed during panics, turnpikes and canals succumbed to railroads, and struggling railroads went bust in the 1840s and 1850s to an extent not previously understood. In short, Siegel's sources had left out the bad parts, producing an overly rosy picture of antebellum stock returns. I mean, you're leaving out... So you can't do that. You can't do survivor bias. And if you're leaving out a third of the freaking S&P 500, which went down, this isn't. I can't believe this. Accounts that of the distant past must stay vigilant against survivorship bias. I cannot look, dude. I talked about John Bogle a lot on this channel, and he has written tons of stuff survivorship bias. There's an article he had written. I haven't been able to find this for a couple of years. Bogle did, where he showed like, based on mutual fund. Well, I can't remember the whole. I'm going to screw it up, but basically they'll throw five ideas against the wall. All right, and one will do well, four will do badly, and they'll only stick with the one that did well, and they'll pretend like the four that did badly didn't exist. And so when they show their performance, their past performance, they'll say, "Oh, look, we started with." Averaging 20% a year on this one category, but we didn't show you the other four. Survivorship bias, that's even worse than survivorship bias. That's basically blatant misrepresentation. I wish I could find that article. I've been looking for a couple of years, probably 8 years to find this article. I can't. But basically what happened, again, a mutual fund will come up with some ideas. They'll say, all right, we're going to backtest, and the beginning of their SEC filing requirements, and then they'll say, okay, so these four things don't work, so we're going to pretend those don't exist. This one did, and they say, look, and then they're going to come to the market. Our back testing shows a rate of return of 85% a year, whatever it is, and that's actually not survivorship bias per se, but it's kind of like that because you're saying, look, we're only going to report on the things that survived. The things that went bankrupt, we're not going to report on, and that's you can't do that. I'm not saying Jeremy Siegel is doing it nefariously. I'm stunned by this. Stunned. All right, so accounts of the distant past must stay vigilant against survivorship bias. That'd be like saying Bethlehem Steel never existed. Enron never existed. Good market history needs to include the losers, the banks that failed, the railroads that never paid a dividend, and the bonds that were downgraded, defaulted. Stunning to me. And then we're going to go here. Odds that the stocks beat bonds over rolls of increasing length. And this is with his real data. And he's a professor emeritus over at Santa Clara University. And you're going to see here all data. It changes everything. 2/3 of the time, over a 20-year rolling period, stocks beat bonds. Going back to basically since the dawn of the United States. That's it, though. Well, that means 1/3 of the time, over 20-year rolling periods, bonds beat stocks. Isn't that crazy? Now you can see from 1943 to 2019, 95% of the time stocks did better than bonds over a 20-year time frame. From 1863 to 1942, it was about 70% of the stocks do better than bonds. Isn't that interesting? And even 50 years, which I thought was pretty interesting. So here we got a frown, not a retirement spending smile. This is an investment frown. So stocks did better than bonds in 20 and 30-year increments, but then it did worse in 50-year increments. I think it's fair to say the results from the entire 226 years in Table 1 are weakly supportive of Siegel's thesis that stocks will outperform bonds. The odds that stocks outperform bonds. His thesis. The odds that stocks will outperform bonds do increase as the holding period lengthens from 1 to 50 years. But using this historical data where we get rid of survivorship bias and not just using tax-exempt municipal bonds, these odds never get much higher than 2 and 3. No enduring lawful relationship between asset outperformance or length of holding period can be extracted from Table 1, 100%. Yeah, you just can't. You can't say the longer I hold, the better stocks would be. It's just we don't see that at all. I mean, look here. Rolls in 1794 to 1862. The stocks never beat bonds. The results are better interpreted as showing changes in regime, i.e. the different circumstances on the ground at the time, World War II. The Rolls analysis broken out by such period is particularly destructive of Siegel's thesis. It supports, instead of time-varying regimes and asset returns, sometimes stocks outperform bonds, sometimes bonds outperform stocks. What matters is not the length of the holding period, but which regime is in operation. The antebellum regime when stocks languished, the regime following World War II when bonds fell out. In fact, across the 2 centuries, there have been 8 episodes where stocks underperformed bonds over multiple consecutive 10-year periods. Figure 5 also shows how unusual the immediate post-war decades were when viewed through the longer lens. And that's the post-war of World War II, where the next 40 years stocks smoked bonds. These decades marked the first time that the 10-year annualized stock advantage exceeded 12 percentage points, and the first occasion where runs showing a substantial stock advantage extended beyond a decade. None of these patterns had occurred before, and they haven't occurred since the 1960s. And yet, if we just look at this thing right here, like, look, stocks for the long run. Anyway, I got so much more to talk about in this article here. It's so right here. Variability of stock advantage or disadvantage over 10-year holding periods. All right, so here we got when the bonds do better. Here when the stocks do better. So right here is that after the World War II up until 30-year time frame from 1943 to 1973. And then you got 73, 74, bonds did better. Then you got the 82. Then you got the great crash of start again. This is a 10-year time frame. This is going to be right here going into 2001 and 2, 2008 and 9. You see what I'm saying? This is the Reagan bear market, the bull market post-war. This is the Clinton. This will be as part of the Obama-Trump. But you can still see there are many. This is the aughts right here. And I mean, look over here. Bonds did significantly better than stocks from 1803 basically till the end of the Civil War. And then from the end of the Civil War until the 1900s is bonds did better than stocks too. So the question is, this right here is the outlier. Is that going to happen again? I don't think so. The decades following World War II are the only example where extreme positive returns on stocks coincided with sustained negative returns on bonds, which produce a large and enduring stock advantage. It is this unique and relatively recent event, faithfully combined with the faulty 19th century sources that led Siegel to extrapolate that in the long run, stocks would always beat bonds by a substantial amount. In fact, Ed goes into kind of like what I say in my book was like, if you're sitting there, let's see, I think he might say, the inflationary surge during World War I and the subsequent mini-depression of 1921-22 caused the 10-year performance of both stocks and bonds to plunge toward the lowest levels for each ever seen. The net effect was a tiny stock advantage for the rolls ending in 1922. I don't know if I can find it, but he talks about like right before 1943, you would have never said stocks for the long run. You never would have said that. You see what I'm saying? And that's what I talk about in my book, where I talk about you're sitting there in 1936. Which inflation do you use? From 1913 to 1925 or 1920, I can't remember, or from 1925 to 1936. Because one was high, one was negative. Which one do you use? Split the difference? And that's what he talks about here. If Siegel was alive in 1943, he would never have written stocks for the long run. Because he had that one decade that changed everything. And right here, right there, that one decade, right there. Not decade, that one 30 to 40 year time frame. Take out that, stocks and bonds, they jockey for position who does better over a 10-year time frame, essentially. I mean, look, these are identical from right here to right there is identical from right there to right there. And you can see it right here. Anyway, I just these people who put their faith in stocks, and I got a problem with that, but just because stocks are long run, you might want to think twice about it. You might want to think twice about it because you're like sitting there, what's your data based on? And this is the same kind of thing with all this, all the conspiracy stuff I follow. People say, oh, it's been proven this, that, and the other. You're like, really? What's your data based on? Eddington, for example, for Einstein. What's your data based on? Let's dive into that. Not Michelson Morley. The redshift experiments. Harvard, Pound Snyder. There's another guy, Pound Snyder and Pound. I forgot the other guy up in Harvard, I think. They did redshift where they're dropping things, lasers from a building to see which ones goes faster, accelerating towards the Earth or accelerating away from the Earth. And it's just as interesting. So we've proven this, and then you start saying, let's see the data on that, shall we? And you're like, ooh. Yeah, in this stage, you got to, who are you going to believe? The professors or your own lying eyes? I'd say, yeah, at the end of the day, I think still safety is a good priority. That's for sure. Love your thoughts. We'll see you.